right, let's jump right in. Welcome to today's explainer, everyone. I am absolutely thrilled to have you all here for what I consider a true masterclass on equity market structure. Listen, whether you're actively grinding for your CFA Level 1 exam or you're just an investor trying to figure out the invisible plumbing of the financial world, you are in exactly the right place. Today, we are tearing down the architectures of trading. We're going to look at how trades actually happen, why they fill at the prices they do, and why understanding this exact structure is honestly the ultimate key to controlling your investment outcomes. Settle in, grab your notepads, and let's get started. Here is a quick look at our syllabus for today. First, market structure foundations. Then, core concepts and orders. After that, a real-world case study on trading TCS. Followed by efficiency and modern AI. And finally, a pop quiz and some pro tips. Let's do this. Part 1. Market structure foundations. So what actually is market structure? To use the classic CFA definition, it refers to the organization and functioning of financial markets. It's the rules of the game. It dictates exactly how buyers and sellers interact, how your specific orders are executed, and ultimately how prices are determined. But there's a crucial piece here: how efficiently information is reflected in prices. That right there is the secret sauce. Market structure isn't just about matching a buyer and a seller. It's about how incredibly fast a new piece of information, like a surprise earnings report or some unexpected economic data, gets digested by the entire market and permanently baked into the price of a stock. Moving right along to Part 2, core concepts and orders. Okay, there are 4 primary market types you absolutely must have locked down. First, quote-driven markets. This is where dealers act as counterparties. They literally provide specific bid and ask prices just to maintain liquidity. Second, we have order-driven markets. Here, buyers and sellers are matched directly with one another, usually by an electronic system. Third are brokered markets, where brokers hit the phones, so to speak, to actively find counterparties for really large or difficult trades. And finally, hybrid markets, which are, you guessed it, just a combination of the other models. If you're taking notes, mentally highlight quote-driven versus order-driven right now. Exam writers absolutely love testing that distinction. Now, once you know the market type, you have to know how to actually step into it. Here is a classic CFA concept to burn into your memory. A market order is all about speed. You're basically yelling to the market, "Get me in right now at whatever the best price is." Immediate execution is the whole goal. On the flip side, we have the limit order. This one is entirely about price control. You are drawing a line in the sand and specifying the exact price you are willing to pay or better. But here's the catch. The trade-off for that price control is that your execution is never guaranteed. If the market never hits your price, you don't get the trade. And listen, the crucial thing to understand here is that trading is never free, even when your favorite brokerage app slashes 0 commissions at you. Commissions are explicit costs, right? You see them right there on the receipt. But the bid-ask spread, that is a massive, vital implicit cost. It's the literal difference between what a buyer is willing to pay and what a seller is willing to accept. And then there's market impact. If you place a truly massive order, the sheer size of your trade might actually drag the price against you before the order is even fully executed. Let's make this real. Part 3, case study trading TCS. Picture this. A group of friends are hanging out discussing their recent trades. We've got Rahul, an everyday investor, and he's staring at his portfolio app in total shock. He says, "Wait, I placed a market order for TCS shares, but the execution price was way higher than I expected." Poor Rahul just experienced the harsh reality of that speed versus price trade-off we just talked about. He wanted to get in immediately, but in a rapidly fluctuating market, his best available price spiked in the literal milliseconds between him tapping buy and his order hitting the exchange floor. Luckily, his buddy Arjun, who happens to be studying for his CFA, chimes in and brilliantly breaks it down. Arjun tells Rahul that because he was trading in an order-driven market, his market order simply marched straight up the order book. It matched instantly with whatever sellers were out there, completely absorbing the available liquidity at higher and higher prices. Arjun rightly points out that if Rahul had just used a limit order, he would have kept his price control and dodged that nasty surprise. Though, again, he would have risked the trade not filling at all. Just to anchor this case study in reality, let's look at the actual exchange Rahul was trading on. India's National Stock Exchange, the NSE, is the textbook poster child for an order-driven market. It's got incredibly transparent pricing and lightning-fast electronic matching. Buyers and sellers are interacting directly through the system's algorithm. There is absolutely 0 dealer intervention going on there. And that's a huge contrast to some other global markets that lean heavily on quote-driven dealer systems just to keep the liquidity flowing. All right, part 4, efficiency and modern AI. So how does all this plumbing build into the bigger picture? It feeds directly into one of the absolute holy grails of finance, the efficient market hypothesis. Remember earlier when we said market structure is about how efficiently information reflects in prices? Well, this hypothesis breaks that down into 3 distinct levels. The weak form says current prices completely reflect all past market trading data. The semi-strong form takes it a step further, stating prices reflect all publicly available information, so earnings, news, economic reports. And finally, the strong form boldly claims that prices instantly reflect absolutely all information, period. Public, private, insider, you name it. So you might be wondering, how do we even navigate structures that are this hyper-efficient today? Well, enter artificial intelligence. Tools like Microsoft Copilot are completely flipping market analysis on its head. Think about it. Instead of a human trader spending exhausting hours manually squinting at bid-ask spreads and volume trends, AI can instantly crunch massive amounts of order book data. It catches subtle price anomalies, it spots dangerous liquidity gaps where a market order would get you crushed, and it can even suggest the mathematically optimal order type based on real-time volatility. It is literally like having a high-speed quantitative analyst sitting right on your desk. Almost to the finish line. Part 5, Pop Quiz and Tips. All right, class, time to see if you are paying attention. We've covered the foundations, the order types, the hidden costs, and the new tech. Here is your CFA Level 1 Pop Quiz. Read it carefully. Which market relies on dealers to provide liquidity? Is it A, order-driven, B, quote-driven, C, brokered, or D, hybrid? Take a second, think back to our market types breakdown, and lock in your answer. Got it? The correct answer is B, the quote-driven market. If you nailed that, awesome job. Remember, in a quote-driven structure, the dealers are the ones constantly standing ready as counterparties. They actively post the bids and the asks to make sure there's always a market, maintaining that crucial liquidity even when natural buyers and sellers don't happen to line up. Before we wrap up this masterclass, I want to give you my absolute top pro tips for crushing this material on exam day. First, memorize your order types cold. The difference between market and limit orders is tested all the time. Second, make sure you truly understand explicit versus implicit costs. That bid-ask spread is a very real tax on your portfolio. Third, watch real stocks like TCS or Alliance trade on a live ticker to see these exact mechanics in action. And lastly, never confuse an order-driven market with a quote-driven market. It's a classic trap, but I know you won't fall for it now. I want to leave you with this final provocative thought. We've clearly seen today that market structure isn't just some dry academic textbook theory. It is the invisible hand that directly dictates your final execution price and your hidden costs. So the absolute most important question you have to ask yourself every single time you hit buy or sell is this. Are you just mindlessly placing trades, or are you strategically tailoring your order types to the specific market structure you're playing in? Master the structure and you master the trade. Thanks so much for joining me for today's explainer, and happy studying.